And tonight we're going to talk about tax strategies and avoiding mistakes and things you can do to reduce your tax bill. And if you missed any of our other presentations that we did over the summer, you can view all of them and listen to all of them on our website, www.anchorbaycapital.com. So I'm Jim Allen. I'm your presenter for this presentation, and I'm the Director of Tax and Financial Planning for Anchor Bay Capital. And so I specialize in tax planning and planning for retirees. And I'm happy to answer any questions you may have at the end of the presentation. You can just type them in the chat box, and I can answer them when we're finished. Or feel free to contact me, and I can answer your questions in person or via email or any other way that works. So let's go ahead and get started. So tonight we're going to focus on tax planning. We've talked about other areas of financial planning over the series. We've talked about estate planning, elder care, and health care. We've talked about cash flow planning and retirement. We talked about what to do with your home. And so we're going to kind of tie it all together with a discussion about some tax ideas that can save you money. So we're going to kind of cover some of the common tax mistakes that we see when clients come in to work with us, and some of the strategies you can use to minimize tax, like tax diversification and tax location and tax loss harvesting. We'll talk briefly about some tax strategies that are available just for 2020, and maybe a couple of them that are for 2021. And then I'll kind of wrap it up with my crystal ball as to what taxes look like going forward. Obviously, we had an election last night. Nothing is definitive at this point, but I'll just kind of give you my viewpoint on what could be going on the tax horizon in the next few years. So our motto at Anchor Bay is, it's not what you make that counts, it's what you keep. And that's why we focus so heavily on tax planning. If we can save you a couple $1,000s in taxes, that's the same as earning you an extra couple $1,000s in your investment return. And it's easier to do, and it involves less risk, obviously. And so that's why we definitely incorporate tax planning into everything we do. And we're just going to talk about some of the things that you can do to lower your tax bill in the future, and some of the things that, if you're not doing currently, we should look at doing to enable you to save some money in the future. So a question I always start with when I'm doing my in-person seminars are, do you think taxes are going to go up? Do you think they're going to stay the same? Do you think they're going to go down? The answer is yes. Nobody knows what's going to happen to tax rates in the future. If you're looking at say a 25 to 30-year retirement, what we do know is that tax rates change about every 4 to 5 years. And so, you're looking at 4 to 5 major tax law changes during a 25 or 30-year retirement period. And so kind of that old maxim that, when you go into retirement, you're going to be in a lower tax bracket, not the case. It very could be that you'll be in a much higher tax bracket for part of retirement, you'll be in a lower tax bracket for part of retirement. And so we can't just assume that you're going to pay less in tax during retirement, because that's not really the case. And so, as I mentioned, about every 4.5 years, the tax laws change. I'll talk briefly about some of the changes we've had in the last few years, because we've had 3 major pieces of tax legislation just in the last 3 or 4 years. So let me start with tax brackets in the United States. So the highest tax bracket we've had in the last 70 years at this point was in the early 50s. We were at 92%. And you can see from this chart, pretty much all the way up until the Reagan years, the max tax rate was, at the lowest 70%. And you can see what the lowest tax brackets were too. They were, typically in the 14 to 20% range. So we're in a low tax environment right now. You can see the lowest we've gotten was 1990, where we had a 28% top tax bracket. We went up to 39.6, and then it's changed a little bit over the past few years, and we're currently sitting at 37%. So if we're looking at over 60 to 70 year period, we're really on the low end of the tax bracket spectrum. It's been as high as 92. Right now we're at 37. The lowest has been as 28. So we're a lot lower or closer to the lowest bracket than we are the top tax bracket. And so this points out, you can look at this chart and just see how often the rates change. And so that's why we have to factor tax planning in, and we can't just make assumptions that you're going to have a static tax rate during retirement. So let me just talk briefly about the recent changes we've had, because as I mentioned, just since the end of 2017, we've had three major pieces of tax legislation. First, we had the Tax and Jobs Act of 2017. That was the biggie. That's the one that President Trump got implemented with Congress, where we lowered tax rates, went from the top bracket at 39.6 to 37. We lowered the corporate rate to 21%. And then there were some revenue offsets in there as well. For example, itemized deductions. In certain states where you pay a lot of property tax or you pay a lot of income tax, you're now capped at a $10,000 maximum state and local tax deduction. So that had that impact on a lot of the clients I do their tax returns for, where they may have 20,000 plus of what we call SALT, and they can only deduct $10,000. So that hurt them. You also have the miscellaneous itemized deductions. For example, you used to be able to deduct tax prep fees. And even if you were an employee, if you had unreimbursed employee expenses, car expenses, or home office expenses, none of that stuff's deductible as well. So yeah, tax rates went down, but at the same time, there were changes to the itemized deduction. What I've seen over the past few years, it's a net win for some people. It's a net loss for other people. You also had the doubling of the standard deduction. So a lot of people nowadays aren't even itemizing on their tax returns anymore because of the increased standard deduction. So that's TCJA. At the end of last year, we had the Secure Act, which is mainly around retirement items. And here, a couple of the major changes were prior to the Secure Act, 70 and a half is when you had to start taking money out of your retirement plans. They changed that age to 72. So that's a positive. We got a little bit longer before you have to take money out of your retirement plans. It's now 72 instead of 70 and a half. But in exchange for things like that, you again have revenue raisers. So you have a concept called the stretch IRA, where you inherit an IRA, say from your parents or something like that. Under the old rules, you could actually take that out over your life expectancy. So if you were 50 years old and you had a 35 or 37-year life expectancy, you could take it out over those 35 or 37 years. And so it was a way to let that money keep deferring and minimize taxes and spread it out. They changed the rule where now you have to take it out over no more than 10 years. So there's still a little bit of a benefit there, but that's directly impacted some of the tax planning strategies we used around inherited IRAs. And then finally, we had the CARES Act, and this is a direct result of the COVID pandemic. And so some of the major pieces of legislation in this were, you may have received that $1,200 or $2,400 rebate check, which is actually a tax credit against the 2020 income tax. That was part of the CARES Act. The extra unemployment insurance, the $600 of extra federal unemployment insurance, was part of the CARES Act. They also suspended those required minimum distributions for this year. So if you were at an age where you were having to take the money out of your retirement plans, you don't have to take it this year. Doesn't matter whether it's an inherited IRA or a regular IRA or 401k. Nobody has to take what we call an RMD this year. And then finally, you have COVID-related distributions, and I've used this with several clients already. Maybe you were job eliminated, or you were temporarily laid off, or you got sick and were in the hospital. They've added provisions where you can take money out of your retirement plans early, under 59 and a half, and not pay the 10% penalty if it's COVID related. Or you can, and it's actually if you're under 59 and a half, you could still do this. You could take up to $100,000 out of your retirement plan if you've been impacted by COVID, and you can spread that tax out over a 3-year period. So let's say you took $30,000 out as a COVID distribution. You pay tax on $10,000 this year, $10,000 in 2021, $10,000 in 2022. So they've added some provisions there to help people, and we've taken advantage of some of these if you've been impacted by the COVID pandemic. But it's not just the regular old income tax we have to worry about. There are other taxes that are either a positive or a negative, and we always look at these to see what we can do again to save on taxes. For example, capital gains. Capital gains have a favorable tax rate in most situations. There's actually a 0% capital gains rate. So if you're a married couple and your income is below $84,000, you don't pay any tax on your capital gain. It's it's 80,000 married and it's 40,000 single. Most people are in the 15% capital gains tax bracket, so you may be in the 22 or 24% tax bracket for ordinary income, but you have a 15% capital gains. And then if you're in the highest tax bracket, that 15 becomes a 20. And then depending on the assets, for example, if you have artwork or real estate that's been depreciated, things like that, you may have a 25 or 28% tax bracket. You also have what are called qualified dividends. So if we're receiving dividends off of stocks, and we do that right, those also get those favorable capital gains rates. So one of the things we're always looking at is how can we make use of those capital gains rates, because paying tax at 15% is a lot better than paying tax at 24%. The other thing we have to look at are state income taxes. I'm here in California as our most of our clients, and we have the highest tax bracket in the country. The top bracket's 13%. Most people are in the 8.3 to 9.3% tax bracket. If you tack that onto a 24% federal bracket, now we're looking at 33, 34% tax. So there's not a lot we can do there. I mean, if you live in California, you work in California, you got to pay California state taxes. They're very aggressive about collecting their money. But there are opportunities, say you're going to move. You're going to retire and move out of state. I've had plenty of clients who have moved to Washington or to Dallas or to Reno where there aren't state income taxes. There's probably things we can do like selling assets or turning on pensions or things where we may not do that until they've moved to become a resident of another state. And, we can go from a 9.3% income tax bracket to a 0 state income tax bracket, and that can save a substantial amount of money. Then there's an additional tax, which is kind of ugly. It's technically called the net investment income, or it's commonly called the Obamacare tax because it was part of the Affordable Care Act, or Obamacare, where if you make above a certain threshold, and it's $200,000 for a single filer and it's $250,000 for a married filer, if your income goes above that, you pay an extra 3.8% tax on your unearned income. So that's not the income on your wages, that's the income on your investments. And you get to pay this extra tax. So for example, maybe you're in the 15% capital gains bracket, but you're above those thresholds. Now your capital gains is not 15, it's 18.8. And the Obamacare tax applies to interest, it applies to dividends, it applies to capital gains, it applies to the sale of real estate, anything that's not wage income, it applies to. And so we're always looking at how can we keep you below that threshold? And we don't want to do things that are going to throw you up there and cost you an extra 3.8% in income tax. And then finally, you have estate and gift taxes, totally unrelated to income taxes. The vast majority of people, it's a non-issue now. We'll talk about that briefly at the end. But essentially, estate and gift taxes apply at a 40% rate once you exceed a certain threshold. That threshold right now is about $11.5 million per person. 99.9% of the population doesn't have to worry about estate or gift taxes. Now, in California, we don't have a state gift or estate or inheritance tax, but there are states that do. I have clients, for example, in Washington State, where the federal exemption is $11.5 million, but the state exemption is only $2 million. And so we always have to look at, are we going to have any issues with that? But honestly, with estate planning these days, and we're going to talk about it at the end of the presentation, most of this is going to be income tax planning related. It's not going to be estate planning related. So let's start talking about some of the common mistakes that we see when we have prospective clients coming in the door. And ideally, our clients don't have these problems because we've worked on them with them. The biggest one is kind of putting all your tax eggs in the pre-tax basket. Very common. No one wants to pay tax before they have to. So they're going to max out their 401k, or they're going to contribute to a deductible IRA and take the tax deduction. And maybe that makes sense, but maybe it doesn't. Again, people used to do this because of the assumption that they were going to be in a lower tax bracket in retirement. Not necessarily the case. So we see this as a problem. You don't want to go into retirement and have all of your money in retirement plans that's going to be subject to ordinary income. And I'll show you how that would work in a few slides. And the next one is not being tax smart about investing strategies. If we have taxable accounts, there are things we can do to minimize the tax. Again, taking advantage of capital gains or qualified dividends, things like that. We'll talk about tax location planning as one of the strategies we use. Not taking advantage of those capital gains rates is a biggie. So those go into what we call tax location planning and tax loss harvesting. We'll talk about those strategies in a few minutes. Another common one is we see probably most clients come in the door with mutual funds. And there's nothing wrong with mutual funds. I used them for 20 plus years until better alternatives came along. But if we're dealing with taxable situations, mutual funds are not a good investment. And we'll talk about the reasons why. And then finally, we'll talk about estate planning and how we can focus on income tax minimization strategies for your heirs. So you don't typically have to worry about the estate tax anymore, but there are things we can do where we can, maybe get you some tax savings on the income tax front when you pass your estate down to your heirs. So the biggest mistake that I talked about is no tax diversification. Everything's in your retirement plans, whether that's your 401k, your 403b, your 457 plan, your IRAs, whatever. The problem with that is if you've taken a tax deduction up front, then they're going to collect their tax later. And so everything coming out is going to be ordinary income, taxed at whatever those brackets are when you take it out. You don't get capital gains rates or anything like that. You're also forced to take the money out of these retirement plans. The thinking is they gave you tax breaks because they wanted you to save for retirement. So at some point they're saying, you know what, we want to start collecting our tax. So that age was just changed from 70 and a half to 72, but you're forced to take the money out starting at age 72, even if you don't want it, which means you're going to have to bite the tax bullet and pay tax. Some people were spending it. Other people, it's like, I don't want it, but we'll just pay the tax and then reinvest the after-tax proceeds. And the other problem with no tax diversification is there's no flexibility. If this is the only bucket to pull from, we have to pull from this bucket regardless where tax brackets are. And so tax diversification is an important concept, and it's usually our first starting point when we work with clients on tax strategies. So the solution is tax diversification. So just like we encourage everybody to be diversified in their investments, don't have all your eggs in one basket, we work the same way here. The idea is we want to have different tax buckets. We want to have some taxable accounts where you have capital gains treatment, and maybe some of it's ordinary income. We want to have those tax deferred buckets where ultimately the money will have to be, the tax will have to be paid, but you don't have to pay it today. And then ideally we would have tax-free buckets where when we pull it out, it's tax-free. And if we've got all these three buckets, then we've got a lot of flexibility. The tax rates are high, pull from the tax-free bucket or the capital gains bucket. And tax rates are low, we pull from the IRA bucket. So if we don't have these accounts, we don't have that flexibility. So this is step one, is to create tax diversification. So let's kind of talk about these three buckets. Pretty much everything falls into one of these three. So from the tax-free bucket, kind of the main one is the Roth IRA. And we'll talk a little bit more about some of these in detail. Health savings accounts. Maybe you don't have one of these, but if you have an opportunity to use a health savings account through your employer or just through your individual insurance, it's a great way to contribute money on a tax-deductible basis for future medical expenses have it grow tax deferred and actually pull it out tax free when you use it to pay for healthcare costs. This is the only investment vehicle that provides tax deductible contributions, tax deferred growth, tax free income. We talked about these in detail in our healthcare and elder care seminar a few weeks ago. You may want to go back and listen to that about health savings accounts. Obviously, municipal bonds are tax free. There's trade-offs with municipal bonds. Yeah, the income is tax free, but in exchange for that tax-free treatment, the returns are reduced. And so it may make sense to have muni bonds if you're in a high enough tax bracket. Often what we see is when we're doing the analysis is that, you know, someone thought they were in a high tax bracket, so they bought muni bonds, and the reality is they're not in a tax bracket, and they're giving up some investment yield. And then finally, home loans, reverse mortgages, home equity lines of credit, those kind of things. Because they're loans and they have to be repaid at some point, those are tax-free. And so, you know, there's scenarios where we'll use a loan like that or a 401k loan to create some tax-free cash flow. And then you have the tax-deferred bucket, which is the most common, and that's your IRAs and your 401ks and your 403bs, et cetera. It's also if you have non-qualified deferred annuities, those provide tax deferral. And then finally, you have the good old taxable bucket. So this is your regular old brokerage investment accounts, you know, with stocks and bonds, and it's CDs, it's bank accounts with interest. It's also real estate if you have rental real estate, things like that. And so we'll talk briefly about how each of these work. And the idea is we want to have money in all of these buckets. And we have to figure out how do we do that. But let's just kind of walk through how the tax treatment in each of these buckets work. And then you can see how, you know, having some money in each of these makes a lot of sense. So let's start with the good old retirement plan. Again, that's your IRA, your 401k, your 403b, et cetera. So generally, contributions are pre-tax. So if you're putting $10,000 in your 401k, it's like you didn't earn the $10,000 for that year. It doesn't show up as salary. So that's a pre-tax contribution. Same with an IRA, you get a tax deduction. It grows tax deferred while you're in there, and you can move the money in between stocks and bonds and various accounts without any tax consequences. But they've given you tax deferred growth and tax deductible contributions. They're going to collect their tax. And so the distributions that come out are going to be taxable. They're going to be taxable as ordinary income. So whatever your tax bracket is at the time you take the distribution out, you're going to pay tax as ordinary income. Also, they've given you these tax benefits, and so they're going to collect the tax. And if they don't collect it from you because you haven't taken it out, when you pass away, they're going to collect it from your beneficiaries. Well, it's called income in respect of the deceased, or IRD. So your beneficiary would end up paying tax on the distributions, and that's where that stretch IRA would come into play. They're going to have to take it out over no more than 10 years, and as they take it out, it's going to be taxable to them. Now, the trade-offs for getting that tax deduction is you have the 59.5 penalty. So if you take the money out prior to 59.5, you've got the additional 10% penalty. There are some exceptions to that, and we'll use those as needed. And then finally, you have to start taking the money out at age 72. If you don't, you have a 50% penalty on the amount you were supposed to take out. So if you were supposed to take out $10,000 and you don't, you're going to have a $5,000 penalty. And so there is no tax bracket that's that high. So it doesn't make any sense for someone to not take those RMDs. And so we're always looking at our clients to make sure that's taken because we don't want to incur a 50% penalty. Then you have the Roth IRA, which is the exact opposite of the retirement plan. So with the Roth IRA, contributions you do not get a deduction for. So you're using after-tax money. And this could be a Roth 401k through your employer, or it could be a Roth IRA. Now, Roth IRAs do have income limits, where if you make above a certain threshold for married couples, roughly $183,000, you can't contribute to a Roth IRA. But assuming you can put the same $7,000 into a Roth that you could into a regular IRA. But the difference is you don't get a tax deduction, you pay tax. It grows tax deferred, just like a regular IRA. The difference is when you pull the money out, it's tax free. And so the way I kind of look at this is with a regular retirement plan, You didn't pay tax on the seed, so therefore they're going to tax the fruit. But the Roth IRA, you did pay tax on the seed, so they're not going to tax the fruit. Which is better? Who knows? Because again, we don't know what tax brackets are going to be. Are you better off getting the deduction today and paying tax down the road, or are you better off not taking the deduction today but never paying tax again? It's hard to say, and that's why what we advise for most people is to have some money in both buckets. Now, the trade-offs with the Roth IRA is, yeah, you don't get a tax deduction. You also don't have required minimum distributions. The government collected their tax up front, so they don't care about when you take the money out. Also, at death, because they collected their tax up front, your beneficiaries can take that money out of that Roth IRA tax-free. So couple caveats. In order to get 100% tax-free treatment, you have to have the Roth for 5 years, and you have to be over 59 and a half. If you do, any money you pull out is tax-free. Even if you don't meet that requirement, you're under 59 and a half, or you haven't had for 5 years, the first thing you pull out of a Roth IRA is your basis. So let's say I've contributed $25,000 to a Roth IRA over the years. It's grown to 50. If I need to pull 20,000 out for an emergency, the first thing coming out are my contributions. Therefore, I don't pay any tax. Now, if I pull out 30,000 instead of 20, I'm going to pay tax on $5,000. And if I'm under 59 and a half, I'm going to pay the 10% penalty. If I'm above 59 and a half and it's been 5 years, it's tax-free. And then finally, you just have your good old after-tax personal investment, so what we call non-qualified investments. So again, you're not getting any tax deductions to these. So the money going in is after tax. Unlike the retirement plans or the Roth IRA, though, this money, for the most part, is taxed currently. And so if you sell something, or if you own a mutual fund and the investment manager sells something, you pay current capital gains tax. If it's a bank account or a CD, you pay interest currently. If it's a stock and it pays a dividend, you pay tax on the dividend currently. Now, appreciation is tax deferred. So if it's a piece of land or a piece of real estate or it's a stock, all of the gain, you don't pay tax until you actually sell it. But it would become taxable at that point, and you would typically get capital gains treatment. So in terms of distributions, all your contributions and the money you paid tax on along the way is tax-free, what we call your cost basis. So, if you've had a CD and you started at 10,000 and it's grown to 15,000 and it matures, you've already paid tax on all that interest, so you can withdraw that money and not pay any tax. If it's a stock, you sell it, you get capital gains treatment. So there's some favorable tax treatment that goes along with that. But for the most part, you're paying tax as you go along, one way or the other. So what happens is when you die, because you have paid tax, they don't really care about collecting tax at death, so you get what's called a stepped-up cost basis. And I'll show you an example of a stepped-up cost basis when we start getting to the gifting strategies. So essentially, these personal investments, for the most part, are tax-free to your heirs because the basis gets stepped up to the value on the date of your death. They can immediately sell it and not pay any tax. And so the trade-offs, you're not getting a deduction, and you're not really getting tax deferral other than appreciation, but it's liquid. We can cash this out at any time. There are no 10% penalties. There are no required distributions. So you have a lot more flexibility. And one of these isn't better than the other. Again, we don't know what tax brackets are going to be. And so the idea is we want to have money in all of these buckets. And then every year, we can evaluate your situation and run some tax projections and figure out where do we want to pull the money from. Well, let me give you an example how this works. So we'll use Bob and Joe as our case study. This is from my Social Security seminar. So Bob and Joe need $80,000 for their lifestyle. And they're getting $45,000 from Social Security. So we're running a $35,000 shortfall. And this is what they have. They have a $750,000 401k, and they have a $250,000 Roth IRA. So where do we get the money from? We know we need $35,000. Well, let's assume we're going to pull it from the 401k because that's the bigger account. So now we have $45,000 from Social Security. We have a $35,000 401k distribution. As I mentioned previously, that's all taxable. So their income is now $80,000, but the vast majority of that's taxable. 85% of their Social Security is taxable, along with all of the 401k. So we're not netting $80,000. We've got to pay roughly $7,400 in tax. So we only netted $72,612. We didn't accomplish our goal. So this isn't a great strategy. So what's the next thing we look at? Well, let's take it from the Roth. So again, same $45,000 for Social Security, but now we're going to pull the $35,000 from the Roth. So now our total income is $80,000, and the Roth IRA income is tax-free. But also, I'm not going to go into how Social Security is taxed tonight, but if you're below a certain threshold, your Social Security is income tax-free as well. And so we stayed below this threshold. Therefore, all $80,000 is tax-free. Therefore, we've met our goal. So that's great. That accomplishes the goal. That's the better plan, right? What's the problem with that? We only have $250,000 in the Roth IRA. At some point, we're going to deplete that, and now we're going to be back into scenario one where we're using the 401k. So what's a better idea? What if we pulled from both buckets? So what if we pulled $17,500 from the 401k, and we pulled $17,500 from the Roth? So we still have $80,000 of income, but it's not all taxable. The $17,500 in the Roth is not taxable. Only some of the Social Security is taxable. The 401k is taxable. So now, yeah, we have to pay a little bit of tax, $1,350, but we got a heck of a lot closer to our $80,000 goal. And we're pulling $17,500 from that Roth. We could probably use this strategy for 10 to 12 to 15 years. And therefore, we're saving a lot of tax, and we're making our money last a lot longer. So this is a prime example of why we want to use tax diversification. And again, ideally, we have a Roth bucket, but also we'd like to have just a regular old non-qualified tax bucket. And we can play that the same game here where maybe, we're pulling it from a stock investment account, we're getting some capital gains treatment, or it's a return of our cost basis, et cetera. So the whole concept of tax diversification is very powerful. And the way we use it is we look at your tax situation every single year, and then we just come up with the strategy that works to minimize your taxes for that year. And it provides a lot of flexibility. And typically we can say, for example, we save Bob and Joan here $6,000 a year. Again, maybe it would be hard for us to get an extra $6,000 of investment return, but we certainly got them $6,000 of tax savings, and that's more than earning our fee. So what are tax diversification strategies? The first thing we have to do is come up with the different tax buckets. And so it may be, rather than sticking everything you can into your regular 401k at work, if you have it available, we put some money in a Roth 401k, and we pay a little bit of tax today. Or if we're contributing to an IRA, rather than putting it all in a deductible IRA, we put some in a Roth IRA. So that's one way we can do to start building up those buckets. Or maybe we don't put it in a retirement plan at all. Maybe we contribute it to those non-qualified investment accounts. And so again, we run tax projections every year to figure out what's the ideal situation. And so maybe there's a little bit of tax pain up front because we're giving up tax deductions, but in the long run, it probably makes sense to do this. Again, we try and run the calculations so that we're not creating additional tax pain. We're just trying to minimize the tax pain today in exchange for a lot less tax pain in the future. So that's one way, is we're making contributions. Obviously, the earlier we start, the bigger we can build these buckets, the more flexibility we're going to have. The other way is to take some of your regular IRA and convert it to a Roth IRA. So let me show you how that works. So what we would do here is we're going to take a small piece of your regular IRA each year. And again, we run projections to see how much. I'll show you an example in a second. And we're going to convert that to a Roth IRA. So money just gets transferred directly from your regular IRA to a Roth IRA, but it's going to be reported as taxable income at the end of the year. And when we do your tax return, we're adding it to your tax return. So you do pay tax on the conversion. And so that's that current pain, just like not getting a tax deduction. However, the trade-off is as long as we hold this for 5 years and you're over 59 and a half, you'll never pay tax again, nor will your kids when they inherit it. There's no required distributions. And so again, you pay tax on the seed, but you're not going to pay tax on the fruit. And it gives us some flexibility in the future for, I like to use them as an emergency fund. If you need to pull $20,000 to put a roof on the house or something, we pull it from this Roth, that's tax-free. If we have to pull $20,000 from your IRA, then we need to pull $33,000 because we got to pay tax on that. And you got to pay tax on the tax. And so you end up in this kind of spiral where you're pulling more and more money out to cover that. So obviously, we could save a ton of tax if we have some Roth money available. Now, we're not going to say take your $200,000 IRA and convert it to a Roth, because now we just caused $200,000 of taxable income. We've thrown you into a higher tax bracket. We've made you subject to that Obamacare tax, all kinds of bad things. So we use what we call partial Roth conversions. And so typically what we're going to do is we're going to convert just enough to keep you in the same tax bracket. For example, here we have John, who's got income of $30,000. So he's solidly in the 12% tax bracket. And for this year, for a single person, the top of the 12% bracket is a little over $40,000. So what we would probably do was we'd say to John, let's convert $10,000 of your regular IRA to a Roth. So now you're still in the same 12% tax bracket. So now you got taxable income of $40,000, but we didn't increase your taxes, and you're probably, aren't going to get a better deal than paying tax at 12%. In the future, you pull it out, who knows what your tax rate would be. So that's typically what we're going to do. It's going to be little pieces every year. And again, we just have to run projections to see what we can do. But slowly over time, either between contributions or conversions or both, we can build up a little bit of money in that Roth IRA and give you a little bit of flexibility down the road. And so that's how we do tax diversification. Ideally, we want to create these extra buckets. We want to get money into them however we can get money into them, whether it's conversions or contributions or both. But we want to start this as early as we can so we have some flexibility down the road. Okay, so then the next one is inefficient tax planning and investment planning. Now, this only applies to taxable accounts. So again, tax diversification is the first step. But assuming you have a taxable account, what we see commonly is that it's not tax optimized. So we're not using tax location planning. We're using tax inefficient investments like mutual funds. I'll talk about them in a second. And we're not using tax loss harvesting. All three of these can save again on taxes. So let me talk about how tax location works. The idea here is we put the tax inefficient investments in those tax deferred buckets. 401ks, the IRAs. So that typically means we're going to put whatever percentage of your portfolio is supposed to be in bonds, that goes into the IRA and the 401k. Or if we're using inefficient funds, the high turnover funds also go in this tax inefficient bucket. The idea there is bonds throw off ordinary income interest every single year that you'd pay tax on, and they're in the 401k and the IRA, we don't pay tax on those. So we've shut the tax off on those. Then what we do in your taxable account is we put the tax efficient investments. The investments that throw off either capital gains or that throw off qualified dividends that are taxed at capital gains, or that have appreciation when we don't pay any tax until we sell, and where we can use tax loss harvesting to use some losses maybe in some investments to offset gains on other investments. Now, this sounds great in theory. It's not that easy to do because very rarely does someone have equal amounts of money in both accounts or something. So this is where I think we really earn our money, is in designing a portfolio where we can do it this as much as we possibly can. But if you've only got 30% of the money in your taxable account and we want to hold 50% or 60% of the portfolio in stocks, we're not going to be able to optimize it ideally. But we certainly do as much as we possibly can. We look at this on a constant basis pretty much every week. We're looking at this. When we're reallocating and rebalancing, we're looking at this because we truly can save you a fair amount of money by using tax location. So example here, in the IRA, you'd hold the bonds. Subject to ordinary income, normally you'd get a 1099 INT and you'd pay tax. If they're in the IRA, you don't pay any tax. When it comes out, you're going to pay ordinary income anyway. So we didn't change the tax treatment. In the taxable account, we would hold stocks and stock exchange traded funds. We don't use mutual funds for the reason we'll talk about in a few minutes. So with stocks and stock ETFs, when you sell those stocks, you incur capital gains, which maybe is at a 0% tax bracket or a 15% tax bracket. You don't have any gains on those stocks until we actually sell them. So we can control the timing of that, and we take that into account. If you're having a high income year, then maybe we don't want to sell some of these stocks and generate some capital gains. Maybe we'll hold off. Or if you're having a low income year, maybe this is the year that we would sell some, take some capital gains, maybe even get you to the 0% capital gains bracket. And then if those stocks are throwing off dividends, as long as we do it right, they can be considered qualified dividends and you get capital gains treatment instead of ordinary income treatment. And finally, in that taxable account, we can use tax loss harvesting. So, like I said, this is a giant puzzle that we have to put together, and each person's situation is going to be different. And I think this is where we really earn our money, is putting a lot of emphasis on tax location planning. So how does tax loss harvesting work? Again, this only applies to taxable accounts. It doesn't apply in a 401k or an IRA. The idea is we can sell investments that have losses, offset the sale of those with gains. And we're, typically selling a loss is a bad thing, but not necessarily. If it's a temporary dip, we can sell that, and we do this commonly. We'll sell the stock, and then maybe in a couple months when it recovers, starts to recover, we'll buy it back, and we'll use that loss to offset capital gains on stocks that we want to sell. And so the way this works is, from a capital gain standpoint, you can offset any of your capital gains with capital losses. So we can start there and net them. And then if you don't have any capital gains left because the losses offset them, you can actually use up to $3,000 of losses on your income tax return to offset ordinary income. And then if you've got losses that are higher than that, then those get carried over to future years. Generally, we're not going to tax loss harvest to create losses like that. We're going to do it to offset gains, maybe create a little bit of excess capital loss. But again, this is just part of the overall tax strategy, and it applies to the taxable accounts. And in order for us to do this, we need to use individual stocks and exchange traded funds, which are traded like a stock, because then we can control the timing of buying and selling, and we can determine the optimal time to do this tax loss harvesting. So that brings me to a discussion of why we don't use mutual funds. As I mentioned before, mutual funds were all we had as a source of, low cost diversification. But the problem with mutual funds, and the reason most people have gone away from them to exchange traded funds or individual securities, is you don't have any control over the timing of those asset sales. So you can't really do tax location planning. You can't do tax loss harvesting because the investment manager at the mutual fund are making these decisions. And they don't care if you're in a high tax year this year or a low tax year. They're simply looking at what's the best for the investment portfolio. And so they're buying and selling stuff all the time. And in fact, some mutual funds are extremely tax inefficient, where they'll turn over the entire portfolio 100% in 1 year. And so every time they do that, every time they sell a stock or they sell a bond, they're probably creating capital gains. And even if you don't take the money out of the mutual fund, you still get to pay tax on that. It shows up on your 1099 that you had these capital gains in the mutual fund. And this is where people's tax plans get torpedoed, where maybe all they have is Social Security. And so, we're not paying any income tax on their Social Security because they're below the threshold. All of a sudden, they've got this mutual fund that created a bunch of capital gains, even though they didn't take the money out, and now their Social Security is taxable. And so you don't have any control over these investment decisions. And some of these funds, like I said, are highly tax inefficient, where they're turning over the portfolio 100%. So using exchange traded funds and using individual securities doesn't create that ongoing tax situation, and we can control it. And because we know your individual tax situation, we can tax maximize as much as we possibly can. So this is one of the problems I see. A lot of people come in with a taxable account that's loaded with a bunch of mutual funds. They've got a tax time bomb on their hand, and they've been getting hit with taxes that they probably weren't even aware of. So that's tax location and tax diversification. Those are the two biggies. And again, those require careful planning. Kind of one of the other topics I wanted to talk about this evening was, what about tax and estate planning? So up until about 10 years ago, we had to worry about the estate tax. At one point, the exemption was $600,000, and it slowly increased up to $3.5 million. But as I mentioned, it had been increased to $5 million, and now it's increased to $11.5 million per person. So unless you're worth more than $23 million as a married couple, you don't have to worry about the estate tax. And next year, the exemption is $11,700,000. Now, one comment on the estate tax: this law is part of the Tax and Jobs Act of 2017. All of that is scheduled to sunset at the end of 2025. So that'll be probably one of the changes. It could happen sooner. Maybe we'll talk about that at the end. But best case, it sunsets in 2025. And if nothing's done, then it reverts back to that $5.5 million exemption. Again, probably most people don't have to worry about a married couple. You're still looking at 11 million plus an exemption. So we don't worry about estate tax anymore. Now the planning is around income tax planning. And the idea here is, as I talked about in our tax diversification grid, in taxable accounts, you get that stepped up cost basis for example, stocks and real estate. So you die with those assets, the kids get a stepped up cost basis, and they can be sold without tax. Retirement plans have that IRD, income in respect of the decedent, where you didn't pay the tax, the beneficiary is going to pay the tax at ordinary income rates. So are there things we can do, again, to kind of maximize taxes at death? And so one of the things we see is, if you're going to do some charitable planning, you want to give something to the Boy Scouts or the Goodwill or Salvation Army or alma mater, your church or whatever, at death, not all assets are created equal. And so the concept here is, what we want to do is pass the good assets to heirs. That's those stepped up cost basis assets. And we want to pass the bad assets to charity. I'll give you an example to see how this works. So John has two assets. He's got an IRA worth $100,000, and he's got a stock portfolio worth $100,000. So typically what we would see would be, John wants half to go to his kids, half to go to charity. He's probably going to name the kids the beneficiary of the IRA. So when he passed away, the kids get the IRA. And then his will would say, I'm going to bequest my XYZ stock to, the Salvation Army or whatever. So how does that look like? Well, the kids inherited the bad asset. They have that IRD tax they have to pay. But if we assume they're in a 30% combined tax bracket, they're going to only net $70,000 of that 100, and Uncle Sam inherits $30,000. Now, the charity inherited the stock, and the stock's worth $100,000 to them, A, because they got a stepped up cost basis, and B, because charities are tax exempt. So they don't have to pay any tax when they sell an asset. So this result isn't what was intended. We didn't split everything 50-50 here. Uncle Sam became a partial beneficiary of the estate. What do? We choose the right asset. And so if we have the kids inherit the stock, so we name the kids as the beneficiary of the XYZ stock in the will, and we name charity as the beneficiary of the IRA, what happens? The kids now inherit that stock with that stepped up cost basis. They can sell it the next day. They net all $100,000. Charity inherits the IRA. I mentioned charities are tax exempt. They cash in the IRA and they don't pay a penny of tax. So all we did was disinherit Uncle Sam. We didn't do anything fancy. We just looked at which asset should we leave to charity, which asset should we leave to the kids. And in this case, we accomplished our goals. And this is one of those mistakes we see. If you want to do, some kind of a philanthropy at death, this is a pretty easy strategy to use to maximize tax savings again. In this example, we just saved that family $30,000 in tax savings. Again, we're more than justifying our fees. In addition to our great money management, we're saving you money on taxes. So let's talk about another strategy that's kind of related, but this is a strategy that we're going to use while you're alive. This is a gifting strategy. And so you're probably familiar with the idea of, hey, I'm going to give things to my kids. Maybe I'm going to give them some money to buy a house or something like that, to get them started. So that's what we call a downstream gift. You're making gifts to a lower generation. And you have a $15,000 per person annual exclusion. So if you're a married couple with 2 kids, you can do this for $60,000 between the 2 kids and not use any of your estate exemption up. So the idea with this is, rather than gift the money down to the kids, we're going to give money to our senior generation. We're going to give it to our parents or our grandparents. Why would we do that? Because if they own it and they live long enough, which is typically they have to live a year, when they pass away, you can re-inherit that asset and get that stepped up cost basis. Now, again, we bypass tax. I'll give you an example. This is a real life case. It was actually a much bigger scenario than this, but I had a client, Joe, who owned a substantial amount of Apple stock. In this example, I just used 1,000 shares. And he did buy it around $20 a share. In this example, I said 25. So that 1,000 shares, Joe paid $25,000 for it. Well, now the stock was at $150 per share. So we've got $150,000 value. So if Joe sells it, he's going to have $125,000 capital gains. In this scenario, Joe had a mother in her 90s, still in good health, but in her 90s. So we don't know how long life expectancy will be. So what we did is we transferred these shares to Joe's mom. So we opened an investment account for Joe's mom. It was what's called a transfer on death. So when Joe's mom passed away, it would pass back to Joe. Now his mom's going to get the dividends from the Apple stock, and technically his mom could cash it in, but she didn't have any intention of doing this. And so in this example, almost exactly a year later, so we crossed that threshold where this is a valid technique, his mom passed away. Joe re-inherited the stock, but now his cost basis was increased from $25,000 to $150,000. And we were able to sell the stock with no capital gains. Again, in this example, we saved Joe $125,000 of capital gains. Or at a 15% tax bracket, that's $18,000. So does this fit every situation? No, but we're always looking for these kind of things to see if we can utilize them. Anything we can do to minimize that tax bite, we want to evaluate. So let's talk a little bit about what's going to happen with taxes in the future here. So first off, the TCJA, which I've mentioned a few times now, is set to sunset 12/31 of 2025. So unless it gets changed or extended between now and then it will sunset and we'll go back to the old rules, meaning we'd go back to a $5.5 million state exemption. We'd go back to a 39.6% tax bracket. Your itemized deductions would come back, things like that. So we'll see what's going to happen with that. As I already mentioned, tax laws change over 4 to 5 years. And, we just had an election last night, but it's important to note that Congress controls tax legislation. The president doesn't make tax legislation. And so what we have right now is looking like is even if Vice President Biden becomes the president, we're going to probably still have a Republican-controlled Senate and a Democratic-controlled House, meaning that there's probably not going to be a lot going on. It's going to probably be gridlock. Not necessarily a bad thing, but it probably doesn't mean we're going to see drastic tax law changes right away. it'll be kind of status quo. And I'll just talk briefly about the Biden tax plan. And so honestly, there weren't going to be significant changes. He's essentially talked about changing taxes on high income earners, and his definition of a high income earner was 400,000. So he would raise that tax rate back to 39.6 for incomes above 400. Kind of an interesting one is right now on your Social Security withholding, once you get to about 138,000, you don't have to pay the Social Security retirement tax anymore. It's capped. What he has proposed was it would still be capped at around the 138, and then you'd have what they're calling the donut hole, where between 138,000 and 400,000, you wouldn't pay any Social Security, but if your income level got about 400,000, you'd have to start paying the 6.2% Social Security tax again. He has proposed removing or lowering the estate tax exemption back to where it was in 2009, which was $3.5 million, indexed for inflation, and the rate would go back to 45%. And you would have a tax credit of up to $5,000 to provide support for elderly parents or disabled people or veterans, things like that. So the things that have been proposed aren't earth-shattering by any means, but even if Biden becomes the president, the chances of these things being enacted in the next few years are probably very low. So we're probably going to kind of have the status quo for a couple years, then we'll see. And again, worst case scenario is TCJA sunsets in 2025, and now we've got our next tax law change. So let's talk about some of the things that are available right now that you can use this year, and then I'll go ahead and open it up for questions, and we'll get you on your way for the evening. So one of the things that was extended for this year is the threshold for deducting your medical expenses had increased to 10%. It has been lowered to 7.5% for this year. So if you're going to have high medical expenses, this is the year to incur those, because the threshold for being able to deduct some of that is much lower. So 7.5% instead of 10%. Also, if you have student loans for your kids or for yourself or whatever, and you have a college savings or 529 plan, you can actually for this year take $10,000 out of that 529 and pay down your student loans, and you get tax-free treatment. They're treating it like you paid tuition. Again, these things are going to expire probably at the end of the year. You also have this year, if you're not itemizing, because now you're taking that higher standard deduction, you can actually take $300 of charitable deductions above the line. So even if you don't itemize this year, you'll still be able to do up to $300 for Goodwill or your church or whatever above the line and take advantage of that. Again, these are all set to expire. And then finally, you have those COVID distributions I talked about, where for this year only, if you were impacted by COVID, either you were sick or a family member was sick, or your income was impacted because you were laid off or you couldn't work or whatever, you could take those distributions from your IRA or 401k and spread that tax out over 3 years. So these are all things, again, they're not going to apply to everybody, but we're always looking to see where they fit, and if they apply to your individual situation, we want to take advantage of them as much as we can. So to kind of, summarize where we're going with here, we're always looking at doing smart tax planning, and it typically starts with tax diversification. And so for most people, that typically means Roth conversions. So every year we're looking at, do we have an opportunity to do a Roth conversion, and how much? We want to get those taxable accounts, so then we can do some tax location planning. We want to be able to use that tax loss harvesting. Also, because of the higher standard deduction, a lot of people aren't able to itemize this year. But one of the things we may do, if possible, is to bunch your itemized deductions. So maybe 1 year you're not making the charitable contributions, or you're not paying all the medical expenses or whatever, and so you just take the standard deduction for that year. And the next year, let's say we make your 2020 and your 2021 charitable contributions in 2021, so we can double up on those. The same with maybe medical expenses, something else. So maybe we can get you over the threshold where you can itemize every other year. It's not going to work for everybody. Depends on your situation. Whether you have mortgage, interest deductions, all of that kind of stuff, property tax caps. But again, we're always looking for those things to see what we can do. And finally, if you're charitably inclined, there are a ton of charitable strategies that you can utilize. The biggest one being what's called the charitable IRA transfer, where if you're over 70 and a half, you can transfer up to $100,000 directly from your IRA to a charity without any tax consequence. Where we use this is where you're forced to take those required minimum distributions. You don't need it, you don't want it. Maybe you were already giving money to your church of a few $1,000s. Well, we can transfer that RMD directly to a charity, and you don't get a deduction for it, but you also don't pay tax. So we can look at doing things like that. Really sophisticated situations, we'll look at using like a charitable remainder trust to bypass a large capital gains, or a charitable lead trust to create some tax deductions. There's things we can do to evaluate whether they fit in your situation. And then finally, we got to be smart about our estate plan. Again, pass the good assets to the kids, pass the bad assets to charity. We look at things like upstream gifting and downstream gifting, things like that. So there's lots of things we can do. It's all very individualized, and so it involves really getting customized to your individual situation to figure out what we can do. But again, as I said at the very beginning, our motto is it's not what you make, but what you keep that counts. And if we can save you $18,000 in capital gains because we did an upstream gift, or we can save you $30,000 because we did the charitable bequest right, or we can save you $3,000 because we used tax loss harvesting, we feel that's just as important as getting you an extra 0.5% return on your portfolio. And so we feel we can really earn our fees by doing really smart tax planning. So how does this apply to Anchor Bay? I mean, we focus on this as one of our specialties. Obviously, we focus primarily on pre-retirees and retirees, but we definitely incorporate tax planning into everything we do. So it's an integral part. We also typically prepare the tax return for our clients. We're already doing this tax planning. We're doing the tax projections. It's very simple for us to prepare the tax returns and e-file them, et cetera. And then we're always acting as a fiduciary. So if we're recommending something like this, these strategies to you, it's because we feel it's in your best interest. And nothing that we recommend is because we think it's better for Anchor Bay Capital. It's only because it's better for you.